All right, listen up, my little money monkeys. Most people think building wealth requires a huge salary, perfect timing, or some secret investment strategy that only Wall Street insiders know. But after more than 20 years of investing, I can tell you something very simple. Wealth usually comes from just two things. Two boring, simple, almost unexciting investments: real estate and the stock market. And the funny part is, most people never use either of them properly. Instead, they keep money in their bank account, spend it on things that lose value, or wait for the perfect moment to start investing. Meanwhile, inflation quietly eats away at their savings every single year. So today I want to show you how normal people, not millionaires, not hedge fund managers, can use these two investments to slowly build real wealth. Nothing complicated, no trading gurus, no get-rich-quick nonsense, just simple strategies that work over decades. Let's start with the first one: real estate. For the last 100 years, real estate has been one of the most reliable ways people have built wealth. Not because houses magically make money, but because real estate allows something powerful: leverage. Let me explain. When I bought my first property, I didn't have a lot of money. I was in my mid-20s, my savings account wasn't impressive, and I definitely wasn't a wealthy investor. But I used a program designed for first-time buyers. That program allowed me to buy a house with only about 3.5% down. In simple terms, I controlled a large asset with a very small amount of my own money. Think about that for a second. If a house costs $200,000, 3.5% is only $7,000. You control the entire property, but you only put in a small fraction of the price. That's leverage. And over time, two things usually happen with real estate. First, the property value slowly increases. Second, a tenant can help pay the mortgage. That combination is incredibly powerful. My strategy was very simple. I bought a house. I lived in it for about 2 years. During that time, the property slowly gained value, and I paid down a little bit of the loan. Then I moved into another property and rented the first one out. 2 years later, I repeated the process again. Buy, live in it, move, rent the previous one. I repeated that strategy 3 times. And after about 8 years, I owned 4 properties, all starting from a small down payment on the very first house. Now, does this happen overnight? Of course not. Real estate is slow. Sometimes the market goes sideways. Sometimes repairs happen. Sometimes tenants move out. But over long periods of time, property ownership has created massive wealth for millions of people, especially because someone else, the tenant, is helping you pay down the loan. Now let's move to the second investment. And this one is even simpler: the stock market. But here is where many beginners make their biggest mistake. They think investing means picking the next winning stock. They watch financial news. They follow internet tips. They chase the hottest companies. And statistically, most of them underperform the market. Professional fund managers with teams of analysts often struggle to beat the market consistently. So what chance does the average person have? That's why the majority of my portfolio is not individual stocks. About 80% of my investments go into ETFs and index funds. An ETF is simply a fund that owns many companies at once. Instead of betting on one business, you invest in hundreds or even thousands. For example, an S&P 500 ETF owns shares in 500 of the largest companies in the United States. Companies like Apple, Microsoft, Amazon, and many others. If those companies grow over time, your investment grows too. And historically, the stock market has done exactly that. Over the past 90 years, the US stock market has returned roughly 10% per year on average. Some years are negative, some years are incredible, but long-term, it trends upward. Now here's where things get interesting. Let's run a simple example. Imagine you invest $300 every month into a broad market ETF. Not a crazy amount. Many people spend that much on restaurants or subscriptions. $300 per month equals $600 per year. If that money grows at an average return of 8% per year, slightly below the long-term market average. Here's what happens. After 10 years, you would have around $54,000. After 20 years, roughly $177,000. After 30 years, about $440,000. And after 40 years, over $900,000. Not because you are a genius investor, not because you picked the perfect stock, but because you consistently invested and allowed compound growth to do the heavy lifting. Compound interest is basically money multiplying itself over time. Your investments generate returns. Those returns generate more returns. And the longer the time horizon, the faster the snowball grows. This is why starting early matters so much. A person who invests for 40 years will usually end up with dramatically more wealth than someone who waits 20 years to begin. Time is the secret weapon of every long-term investor. Now, remember earlier when we talked about real estate and stocks? The real magic happens when you combine both. Real estate can generate rental income and property appreciation. Stocks and ETFs provide diversified growth across the global economy. One asset produces cash flow. The other compounds quietly in the background. Together, they form a powerful long-term wealth strategy. But there are 3 rules every beginner must follow. Rule number 1. Consistency beats timing. Invest regularly, monthly, automatically if possible. Do not wait for the perfect market moment, because most people who try to time the market end up sitting on the sidelines. Rule number 2, keep emotions out of investing. Markets go down sometimes. That's normal. Every major market crash in history eventually recovered. Investors who panic and sell during downturns usually lock in losses. Patient investors stay invested. Rule number 3, think in decades, not weeks. Wealth building is not a sprint. It's more like planting a tree. At first, nothing seems to happen. But year after year, the roots grow deeper, the branches get stronger, and eventually the tree becomes massive. Investing works the same way. Small contributions, long time horizon, consistent discipline. If you follow those 3 principles, your future self will be extremely grateful. And here's the best part. You don't need to be rich to start. You don't need to understand complicated trading strategies. You don't even need perfect timing. All you really need is patience, discipline, and a simple plan. Buy assets. Hold them long term. Keep investing. That's it. No Lamborghini promises. No overnight millionaire stories. Just steady progress toward financial security. And in the end, that's what most people really want. Not private jets, not mega mansions. Just the freedom to live life without constant financial stress. The ability to choose how you spend your time. That's real wealth. So if you take one thing away from today's video, let it be this. Own assets. Real estate if it fits your situation. Broad market ETFs for long-term investing. Start small. Stay consistent. Give your money time to grow. Because in the long run, the investors who win are not the smartest. They are simply the ones who stayed in the game the longest. If you enjoyed this lesson, make sure you subscribe to the channel and hit the like button. It helps the channel grow, and it tells the algorithm that the money monkey should keep teaching financial wisdom from the jungle. And remember, if a monkey can understand investing, you can too. This is Money Monkey, and I'll see you in the next video. Monkey Money Bag.